Greg, how you doing, mate?
Woody, I'm pretty well. How are you going?
Not too bad. I thought we'd change it up a bit today. Normally we do a video on Friday. I know you do a video now and again midweek, but we got quite a few things to talk about. I alluded last week to a survival plan that we are working on for your newsletter, and also to show people. Well, you got some interesting views on it. The bear market has been pretty brutal. The ASX 200 peaked last August. It's been in a downtrend ever since, and people are probably feeling a bit of pain. So we were discussing how do we help people survive the bear and get ready for the subsequent bull market, because the other thing that you say is that it will end, and it's probably going to end a lot sooner than people think.
Yeah, and I think part of the reason why we're trying to put this plan together is to give people a little bit of context for where the market has been and where it's potentially going, and what could be the catalyst, or what are the signposts to sort of look at for when the bear market, not necessarily coming to an end. And I'm not suggesting we go from bear market straight back into bull market conditions. These transitions do take some time. But I guess the main point that I would try to get across is that we're not going into a prolonged multi-year bear market downturn, not a 2008 type situation. That was a very specific internal market sort of breakdown where collateral values that were all based on global property prices completely collapsed and the financial system nearly imploded. We're not in that situation at the moment. The global banking system is a lot stronger than what it has been. The key cause of this bear market has been a global supply constraint issue, which has led to a big increase in inflation. And that has led central banks to go from very, very easy monetary policy to tightening at the fastest pace since the early 1980s. On top of that, you've got quantitative tightening, which means the Fed has gone from expanding its balance sheet to now shrinking its balance sheet. That's due to ratchet up again from the 1st of September. So you've got all these factors coming together that's tightening monetary policy and seeing inflationary pressures ease. And I think that's been the key theme that I've been talking about in Insider over the past few months, is that this inflation that everyone is concerned about, and we're clearly seeing it. You're seeing it at the petrol pump, you're seeing it, price rises just across almost all levels. So I'm not saying that inflation's not there. What I'm saying is, from a market perspective, and that's what we're talking about here, we're talking about financial markets. Yep. Inflation is yesterday's story. We're going into a slowdown, and the more the Fed tightens, the deeper that slowdown is going to be. And I think as the Fed gets to that point, it's sort of the bear market, the signposts of the bear market ending is increasing. So the first thing you need to see to get comfortable that the bear market is coming to a close is the Fed to sort of give up on their rate tightening cycle and say, hey, we've done enough. We're going to stand pat for a little while. And I think that's coming up in. Sorry. Yeah.
So no, go for it. Finish.
No, I was going to say, I think that that process is playing out, and I think the Fed gets to their September meeting. So they've got one more meeting at the end of July. They don't meet in August, and I think that's when you have the Jackson Hole Symposium, where all the global central bankers get together, and I don't know what they do, to be honest. But and then in September they meet again, and I think that's where you see a change of language from the Fed, and I think we're getting obviously getting closer to that point.
I was going to say, well, let's speculate a little bit. What do you think is going to happen in the July meeting? Do you think they're going to raise it to a certain extent, and that's going to overshoot slightly, and they're going to realize that in September, basically? Is that what you're saying?
Well, look, the market's pricing in 75 basis points for the July meeting. Now we're having this conversation just before the June inflation figure comes out for the US. But the thing is that's a backward-looking indicator, right? So we're getting the June inflation figures in July. So inflation is always going to be a backward indicator, but the Fed will be influenced by that. And if I think the market's pricing in a relatively high number, maybe around 8.5%, if it's lower than that, that will probably see all assets, risk assets like the NASDAQ and S&P 500, our market, gold, commodities, they will probably rally and you'll see bond yields fall. So that will be the first sign that maybe inflation has peaked. If the number is worse than expected, maybe up around the annual 9% rate, you're probably going to see even more sort of selling, just because they think, okay, the Fed has got to tighten even more than we expected. But as I said, like, I think by the time September rolls around, you're going to see a lot of more data showing that the US is probably in recession already. And this is something I talk about a lot in the Insiders. And without getting too technical, we talk about the yield curve a lot. And a normal yield curve is short-term rates lower than long-term rates. At the moment, it's the other way around. Long-term rates, the 10-year bond yield is lower than the 2-year bond yield. That generally means the bond market is signaling a sharp economic slowdown and a recessionary conditions. So this happens very rarely, and when it does, it's probably one of your best indicators that we're going into recession. There's loads of other forward-looking indicators that show the US economy is slowing down sharply. We're not in any situation like that in Australia. The bond market is signaling a slowdown, but that's pretty normal considering that the Reserve Bank is raising rates as well. But at the moment, where the Aussie economy isn't looking too bad in terms of what the bond market's saying. US, different picture, which is why I think the Fed is going to be the first central bank to say, okay, we've clearly squeezed inflationary pressures, and I think we're happy to take our foot off the brake for the next few months. That's going to be my first signpost that the bear market's coming to a close.
I think that, and the challenge for a lot of people during this tricky time, because the bear market is going to roll on for a little while yet, right? It's like you say, it's not just going to switch from a bear market to a bull market. But one of the things, what I observe just working with you day in, day out, is that you're very rational and you're a proper contrarian, and you actually are. It's just your natural state. But for many people, it's not their natural state, right? So you tend to make some quite bad decisions during these times. But you're looking at the market pretty rationally, and you're more using this time to see what's going to come next and how you can position people for what happens next. How are we helping people to do that?
Yeah, I think it's a good point you make, because I've been in markets for quite some time now, and it's not always easy to take that contrarian view. But what you have to try to teach yourself is the market's always looking ahead. So whenever you see a headline, whenever you see a company announcement, news that you know about, that is in the price. That is priced in. So what I try to do is use headlines a lot to see what the market's thinking, and then I try to look ahead and say, well, where's things going? So a couple of months ago, when I was writing about peak inflation, that was when the headlines were saying, here's how you can protect your portfolio from inflation. Buy energy stocks, buy commodities. And at that point, in my advisory, I was selling some of the energy exposure that we'd had because we'd bought it back in 2021. We'd made some good profits from the rally, and I thought, this is becoming so well known that this is not everyone knows that inflation is high, and you buy energy stocks. To me, that's almost like a sell, and that's the contrarian nature that you have to train yourself to think. So at the moment, I'm looking forward and saying, okay, the bear market is starting to be increasingly priced in. There are a lot of quality stocks out there that have fallen 50% from their highs. So now I want to look at those stocks and do the work on the valuations, do the work on the analysis to see what the threats and what the growth opportunities of these stocks are. And I want to be getting ready to buy them, because in a bull market, really good stocks will be priced for growth for the next 5 and 10 years. So it's really hard to buy good stocks at a reasonable valuation. In a bear market, everyone forgets about the long-term growth prospects, panics about the liquidity constraints, the short-term headwinds to revenue growth, the short-term headwinds when it comes to cost increases, margin squeezes, all that sort of stuff. And no one wants to think about the long term. Everyone's thinking about the short term. So that's when you have to switch your thinking and say, okay, there's some quality stocks that have fallen a lot. Maybe I should be looking at them and looking at, potential entry points in the next few months, because when the bear market does return, these are the stocks when the bull market does return, these are the stocks that you want to own. And that's what I've been working on sort of behind the scenes in the past week or two, is trying to find a handful of good quality stocks that have really been knocked around and I think have got good long-term prospects.
Yeah, not to give any details away, because your readers of the Investment Advisor will get this, I believe, in the next month's edition, and we're going to make it a portion of the report available for insider readers and anyone that wants to have a look. But you were saying just before this recording that one of the picks specifically it's a great Aussie company that's globally expanding. But for the first, and you were saying it's very difficult when you're globally expanding to find value in it. But because of the recent bear market, that's actually happened, which makes it quite exciting.
Yeah, absolutely. And, I'd probably say that's evident in 4 or 5 of the stocks that I've looked at. These are really high quality stocks that in general, and if we just use a basic valuation parameter like PE ratios, in general trade at really high PEs, low dividend yields. They're just expensive because the market is willing to pay up for the growth and the quality of the company. And that's fair enough, but the higher the price you pay, the lower that your long-term return is going to be. But now that we've seen, as I said, 50% price falls from the share price peaks for the first time in a long time, aside from the 2020 COVID panic, which saw the market dip quite drastically for a very short space of time before it bounced back up again. But here you're sort of seeing a more methodical bear market that's opening up these opportunities to take a position in some quality stocks that, frankly, I think you only get during bear markets. And that's the thing I don't want. I don't want this opportunity to go to waste. So I'm trying to do all the research on, the top handful of stocks that I think are worth buying when the bull market returns.
Specifically for a long-term portfolio mindset.
Yeah, at least for the next couple of years, I would suggest. Yeah.
So let's just briefly touch on another aspect of it then. So because you're actually very bullish, not too bullish, but you're actually very positive on Australia's prospects over the next couple of years too. Do you want to expand a little bit on why? Because like we discussed, you don't believe this is the all-encompassing global GFC mark number 2. This is a bear market that we really needed to have. But you reckon Australia specifically is quite well positioned to come out of it and benefit from any bull market that subsequently arrives, right?
Yeah, and I think so. The key reason behind that idea is that one of the worst things for stock markets and one of the worst things for asset prices in general is if interest rates and inflation get out of control and they have to keep rising. Like, I think that's where you could paint a case that it could be a really ugly bear market, especially in Australia with our very high house prices. If the central bank, I think the market's suggesting that the RBA might raise rates up to 3.5% by next year. And I honestly don't think that's going to happen because it would cause a housing crash. So my view is that this inflation, and I know it's not a popular view, but my view that this inflation has mostly been supply side led. Those supply side constraints will ease over time. It's not going to go back to the supply chains how they were pre-COVID, but they will ease. And I think you're going to see inflation levels come back down to more normal levels that we've seen over the past 5 or 10 years. I don't think we're heading into a structurally much higher inflation regime than what, as a lot of people are saying. So that sort of view underpins my, bullishness. I think this is a short-term squeeze on inflation to try to get the headline inflation numbers down. I think that'll work. But I think at some point you're going to see central banks turn around and say, okay, we're going to hold off interest rate rises. There's an obscure market called the Eurodollar futures market. And it's like a global interest rate market. That's pricing in a global recession. It's pricing in lower interest rates in 2023. So it's not just me sort of coming up with this idea without any sort of support. There's some major global markets that have this view as well. They're just not so much talked about in the business pages. So on the back of that view that central banks have caused this tightening and central banks have caused this bear market, I think they will be the ones that turn this around. So I probably got off a bit of track from the original question, but I think the reason why Australia is well placed here is because we didn't go through a huge speculative boom, like you saw in the Nasdaq and a lot of those stocks on the US exchanges. So I think the downside is probably a little bit more limited. Secondly, in the 2000s, we had China emerging, and that sort of underpinned demand for our resources. This time around, we've got this green revolution that's going to see trillions of dollars put into the energy transition from fossil fuels into green energy. Now, I'm skeptical that green energy is going to do anything like the people who are sort of fans of it hope it will, but that doesn't mean the money won't go into the sector. And it is a hugely commodity intensive process to get the energy grid reworked to work for renewable technology. So that is going to underpin demand for Aussie resources for many years to come. On top of that, you've got coal prices that haven't even budged from their very high levels. And now coal is one of the biggest export earners for Australia. Iron ore prices are coming off quite a lot because China's slowing down, but still we produce a huge amount of iron ore, and that's going to produce a huge amount of income for us. So the income from all these commodities will continue to underpin our housing bubble. And if interest rates stay low, there's no reason why housing prices can't continue to stay high, because we've got the income to support it. So for that reason, I don't think the downside is going to be all that extreme in Australia. Like if you compare it to the 2000 tech bubble that went in the US, the Nasdaq fell 80% from top to bottom over those couple of years. The Aussie market only fell 23%. So, I look at the similarities, and to me, there are a lot of similarities between the 2000 bubble and now. And I think Australia is well placed to deal with the bear market, and I think we'll come out on the other side pretty strong as well.
Well, I was just going to read a little quote from the report it's a little excerpt that we're going to use, but there was a report on mines, minerals, and green energy, a reality check, and it was from the Manhattan Institute, from a fund manager. But the key quote: compared with hydrocarbons, green machines, solar and wind farms entail, on average, a 10-fold increase in the quantities of materials extracted and processed to produce the same amount of energy. This means that any significant expansion of today's modest level of green energy, currently less than 4% of the country's total consumption versus 56% from oil and gas, will create an unprecedented increase in global mining for needed minerals. And I mean, they say Ukraine.
You don't need me to add much more than that.
I know you say Ukraine's the bread basket of the world, but Australia is kind of the bread basket in terms of resources, right? So that's a pretty
absolutely, and it runs through the whole range of resources. You've got the bulk commodities that are going to continue to be needed. We've got huge resources of gas. I think we are maybe the second largest producer of LNG in the world. And then you've got nickel and copper and rare earths, and just there's everything there we have to I guess benefit from this transition. Now, whether it produces the energy it's needed to, I've got no idea, and I have my doubts. But as I said, there is such a political momentum behind it. You just know that there's going to be a lot of money thrown at this opportunity in the next decade, and Australia's well placed to take advantage of it.
Cool. All right. Well, Greg, I think we'll leave it there. Nice little chat just to set up what we have planned. Hopefully in the next week. We're working hard to get it out.
Yep.
And what it will entail is a few ideas that we'll give away for free on how to survive and prosper and turn to your advantage the remaining however many months we have of this current bear market. But then we hope to also publish a report with a watch list of high quality picks for when the market turns, basically.
Yeah, and look, I'd just finish by saying that bear markets are about surviving. If you can survive a bear market with capital intact, you're there to take advantage of the opportunities when the market turns, which it inevitably will. And I would also say that I don't think the bear market's going to be as bad as what a lot of people are expecting. I still think that there might be more selling to come. And I talk about this with my subscribers as well as in Insider. There is a risk that we'll get more downside if the Fed continues to tighten. But, yeah, as you said at the start, the ASX 200 peaked in August last year. So we're coming up to nearly a year of the market heading, trending down. The US market's probably a little bit later in that, but the US market has fallen a lot more than what we are. So we're already significantly, partway through this bear market. So my advice would be to, keep your eye on the opportunities and not get too sucked into the everyday fear that you can get when the panic hits. So, and hopefully we'll be able to help you through it.
Awesome. Thanks, Greg. Great chat. And I'll leave you to get back to the report.
Thank you.
Cheers. See you guys.
See ya.